Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Intel.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you need emergency cash and want to look at a short-term installment loan option, you can check out MaxLend Loans through my link below. Eligible customers may qualify for loan options up to $3,750, and funding may be available quickly if approved. But please be careful. Always read the full loan agreement, APR, fees, repayment schedule, and total cost before signing anything.
Okay, so I want you to imagine a bloated 55-year-old legacy tech company.
Right.
Like the kind of company that basically everyone on Wall Street had just completely written off as dead money. A total dinosaur from the old PC era.
Yeah, totally.
Now, I want you to imagine that exact same dinosaur suddenly surging 114.1% in a single month.
It's crazy.
Right. That just doesn't happen. Yet in April of 2026, that is exactly what Intel just did. It's just a staggering reality.
It really is an extraordinary event to witness. I mean, we are talking about a stock that finally punched through its dot-com era all-time highs to set an absolute new record of $100.45.
Wow.
Yeah, and to put that in perspective for you, for over 2 decades, that dot-com peak was the ultimate ceiling. Like, it was this impenetrable wall where literally every rally went to die.
Yeah, it was cursed.
Exactly, and they just blew right past it like it wasn't even there.
Which brings us to the mission of today's deep dive. We're going to deconstruct how a company that, the broader market largely viewed as a struggling legacy brand somehow managed to completely reinvent itself.
Completely.
Because we're looking at a 412% rally from its 52-week lows. And we need to figure out exactly how they pulled this off, the mechanics of the tech driving it, and more importantly, what this historic turnaround actually means for your portfolio right now.
All right, let's move into the wealth building context.
Because that is the crucial question for anyone listening today. I mean, how does a legacy hardware company even fit into a modern, forward-looking portfolio?
Right.
As an investor, my immediate instinct is to be, well, extremely cautious, highly analytical, and frankly, a bit skeptical. When a dinosaur suddenly starts sprinting, you really have to ask yourself, is this just a temporary sugar rush from some AI hype? Or is this like a fundamental, irreversible shift in the company's DNA?
That caution is completely justified. I mean, you have to ask those questions. But if we connect this to the bigger picture, the core thesis here is that Intel is no longer just a PC chip maker.
Right.
That old identity is just dead and gone.
Yeah.
They are successfully transforming into what the industry is calling a sovereign foundry. And they're rapidly becoming the advanced packaging backbone for literally the entire Western AI infrastructure build-out.
Okay, sovereign foundry, that's a heavy kind of geopolitical term. Let's break that down for the listener. To understand this pivot, you have to think about a famous chef. Imagine a chef who realizes their restaurant is losing popularity. Instead of just trying to sell their own food, they decide to rent out their state-of-the-art kitchen to all their competitors.
That's a great way to look at it.
Right. They don't just want to sell their own meals anymore. They want a cut of every single meal cooked in town. That's a foundry. But the sovereign part, you're really talking about a massive geopolitical hedge, aren't you?
Exactly. This is about structural de-risking on a global scale. Right now, approximately 92% of the world's most advanced microchips are manufactured in Taiwan.
92%. That's wild.
Yeah. So from a wealth building perspective, if you are invested heavily in tech or AI or software, your entire portfolio is essentially sitting right on top of a major geopolitical fault line.
Yeah, highly exposed.
Right. Hyperscalers, the massive cloud providers like Amazon and Google, who are actually driving this AI revolution along with Western governments, have realized this is just an unacceptable single point of failure.
Because if something happens over there...
Exactly. Intel is stepping in to offer a structural alternative. They are building the physical capacity to make the world's most advanced chips right here on Western soil.
So holding this stock isn't just a play on AI growth. It's actually an insurance policy against global supply chain disruption.
Precisely.
If a crisis hits the Pacific, the software algorithms and the AI models, they don't matter if you can't physically build the hardware to run them. It's a way to insulate your portfolio from those geopolitical shocks while still participating in the AI boom.
Yeah, it's basically a foundational asset for the next decade of domestic tech infrastructure.
Okay.
Now let's look at the fundamentals.
Because Narratives and geopolitical hedges, they make for great stories, but eventually the math has to back it up.
Oh, absolutely.
114% rally in a month demands absolute perfection in the underlying financials.
And the math just showed up in a profound way. The Q1 2026 earnings report was an absolute shocker to the upside. Revenue hit $13.6 billion.
Wow.
Yeah, that is a 7.2% year-over-year increase, and it beat the company's own internal outlook by a massive $1.4 billion.
Well, wait, the bottom line is what really blew people away, right?
No, the real stunner, the number that caught literally every single analyst completely off guard, was the bottom line. Non-GAAP earnings per share came in at 29 cents.
29 cents. And what were they expecting?
Analyst consensus was sitting down around a penny or two.
Oh my God.
Yeah, they absolutely obliterated expectations.
Obliterated is the right word. I mean, at 29-cent EPS, when Wall Street expected 1 or 2 cents, means the institutional models were just completely broken.
Totally broken.
It forces a total repricing of the asset.
Yeah.
But, let's look under the hood. Where is that cash actually coming from?
It's coming from the exact segments you want to see growing. The data center and AI segment, or DCAI, jumped 22% year-over-year to $5.1 billion.
Okay, that's solid.
And this was fueled by heavy deployments of their new Xeon 6 processors, and crucially, their custom AI ASICs just crossed a $1 billion annual run rate.
Wait, let's pause right there. What is an ASIC?
Good call.
For you listening at home, ASIC stands for Application-Specific Integrated Circuit.
Think of a standard CPU, like a Swiss Army knife, right? It can do a little bit of everything, but it's not the absolute best at any one specific task.
Right.
An ASIC is like a laser scalpel. It is custom designed from the molecular level to do exactly one job perfectly, which right now is training AI models. So hitting a $1 billion run rate on those custom chips is massive.
It's huge. And then you look at the foundry services side, the actual manufacturing business we talked about earlier. Revenue there hit $5.4 billion, which is up 16%, as their advanced 18A manufacturing node finally moved into high-volume production.
Okay, and margin. On top of all that, gross margins expanded to 41%.
Okay, I have to jump in here and play the skeptic, because 41% gross margins are fantastic, but we really need to talk about the balance sheet baggage.
Fair enough.
If you look at their free cash flow last year, it was severely negative. We're talking roughly negative $3.2 billion.
Right. It's a lot of cash burn.
It's insane. Building next-generation semiconductor fabrication plants, these fabs, is arguably the most capital-intensive undertaking in human history.
Oh, without a doubt.
You're buying extreme ultraviolet lithography machines that cost, hundreds of millions of dollars apiece? That negative cash flow is a massive anchor around their neck.
It's a very fair point. The capital expenditures required to build these fabs are eye-watering. I mean, they really are.
Okay.
This is where the structural safety nets come into play.
Okay.
First, they executed a $14.2 billion reconsolidation of their Ireland Fab 34 facility, which proves they have the liquidity and the strategic agility to manage these massive physical assets. But the ultimate safety net, the thing that allows them to burn that cash, is the U.S. government. Through the CHIPS Act, they secured an $8.9 billion investment.
Right.
The U.S. Treasury now holds a 10% equity stake in the company, which is currently valued at over $40 billion.
Let me stop you there, because that detail is just wild to me. I look at that 10% government stake as essentially a sovereign put option.
That's exactly what it is.
It's the U.S. government loudly signaling to the free market that this company is officially too strategic to fail. If you're an investor, having the Treasury Department as a co-owner of the business radically changes the risk profile. It effectively puts a floor on how far the stock can fall.
It completely changes the calculus,
Oh, yeah.
and it gives them the breathing room to scale their other massive advantage, which is advanced packaging.
All the packaging wars.
Yes. Right now, advanced packaging, specifically a technology they call EIB, is bringing in billions of dollars annually. It is a direct rival to TSMC's CoWoS packaging. And as the ultimate flex to prove their technology is actually working, their Xeon 6 was just selected as the host CPU for Nvidia's next-generation DGX Rubin NVL8 systems.
Okay, let's make sure the listener really understands the packaging war, because this is critical. TSMC uses a technology called CoWoS.
Right.
Think of CoWoS like building a massive single-level mega highway for data to travel across chips. It is incredibly fast, but it's incredibly hard to build. And right now, TSMC has a massive traffic jam. They literally cannot build these mega highways fast enough.
They are totally backlogged.
Exactly. Now, Intel's EMB technology is more like building highly efficient, specialized little bridges connecting different chips directly on the motherboard. It's easier to scale, and it bypasses TSMC's traffic jam. And the fact that Nvidia is using Intel's host CPUs in their own Rubin systems proves Intel is embedding themselves directly into the competitor's ecosystem.
That brings us to the catalyst timeline.
Right. Because we have the historical context, we have the current fundamentals, but as investors, we need to know what is going to drive the stock in the immediate future. The market is forward-looking. So what happens next?
Looking ahead to the next 3 months, the guidance for Q2 2026 is incredibly strong. They're projecting $14.3 billion in revenue and 20 cents in EPS.
Okay.
But the real tangible catalysts are the customer wins. They just signed Tesla as the first major customer for their cutting-edge 14A node at the near Austin Terafab complex.
That's a huge name to pull.
It really is.
Yeah.
And Amazon just secured a multi-billion-dollar custom AI chip contract with them.
Okay, for the listener, when we say 14A node, think of it as the atomic scale of manufacturing. They are shrinking the electrical pathways on these chips down to the width of literally a few atoms to make them faster and more power efficient.
Exactly.
And Tesla absolutely needs that because their full self-driving AI requires insane amounts of compute power.
Mm-hmm.
But I have to push back here a little bit. Tesla and Amazon are great headline wins. But 114% rally isn't built on just 2 contracts. Wall Street is whispering about something much bigger, aren't they?
Oh, absolutely.
I'm looking at TSMC's packaging bottlenecks, and I have to wonder if Intel's competitors are about to become their biggest clients.
You are reading the tea leaves perfectly. The major speculative catalyst right now involves Nvidia. Because TSMC is so bottlenecked with that CoWoS packaging capacity we just talked about, there are heavy rumors that Nvidia may be forced to use Intel's EMIB packaging within the next 18 months just to meet the insatiable demand for their AI chips.
Wow.
On top of that, there are very credible reports that Google's 8th generation TPU, their own custom AI chip, might also utilize this EMIB packaging.
That is the ultimate irony. Nvidia and Google might actually have to pay Intel just to get their own chips out the door.
Now let's pivot to the chart.
Because these fundamental catalysts are translating into some of the most aggressive market action I have ever seen for a mega cap company.
It's historic.
It really is. I'm looking at the data from April 23rd, the day after that Q1 report dropped. We saw a 23.6% single-day rally.
Insane.
That is the kind of explosive move you expect from, like, a tiny microcap biotech stock that just cured a disease, not a foundational tech giant. And the volume totally confirms it. Average daily volume exploded to 105 million shares.
Massive.
That is undeniable, relentless institutional accumulation. Wall Street wasn't just casually buying, they were literally panicking to get in.
And that ties directly into the mechanics of breaking that multi-decade resistance line we talked about earlier. When a stock breaks a ceiling that has held firm since the dot-com bubble, it creates an absolute nightmare for short sellers. It triggers a massive short squeeze.
Let's explain that dynamic for you listening. A short squeeze is basically like someone yelling fire in a credit theater, but the only exit is buying the stock.
Exactly.
Short sellers bet the stock would go down. When it rockets up, they are forced to buy shares to cover their losing bets, which acts like gasoline on a fire, pushing the price even higher.
Right. But beyond the mechanics of the squeeze, it shifts the entire market psychology. We have officially moved past turnaround speculation.
Right. It's not a what if anymore.
No, the market is no longer hoping they can fix the business. The market is aggressively pricing in a new industry paradigm where Intel is a dominant, indispensable player in the AI era.
So what does market sentiment look like? If the chart is that parabolic, how are the analysts in the broader market reacting to this new reality?
The mood is distinctly bullish, and it's a dramatic shift from the deep skepticism we saw just a year ago. We are seeing validated optimism across the board. But the biggest narrative driver, the absolute whale in the room, is Apple.
Okay, let's unpack this. Apple is famously married to TSMC. TSMC has manufactured Apple's silicon flawlessly for, what, a decade?
Yeah, a long time.
Why would Apple even consider looking at Intel?
Because Apple is looking at the exact same geopolitical map we are. Apple is actively holding exploratory talks with Intel about utilizing their U.S. chip manufacturing capabilities because they want to diversify away from TSMC.
That makes sense.
Right. Apple realizes that if one major supply chain disruption hits Taiwan, they literally cannot sell a single new iPhone. They need a geographical hedge just as much as anyone else. If Intel can secure even a tiny fraction of Apple's silicon volume, it represents a massive expansion of their total addressable market. It would be the ultimate seal of approval.
And the analysts are clearly front-running that possibility. We're seeing a massive wave of upgrades. Freedom Broker upgraded the stock to a buy. D.A. Davidson raised their price target to $77. Benchmark went even further and raised their target to $105.
It's a pile-on.
When the analyst community starts chasing the price action with upgrades like that, it tends to create this sort of self-fulfilling feedback loop of positive sentiment.
Now let's talk about the risks.
Right, because my job is to look for the cracks in the foundation. And after a 412% rally, there are always cracks?
Always.
The most glaring issue to me, looking at the numbers, is the valuation. We are looking at a staggering forward price-to-earnings ratio of roughly 125x.
It's high.
I need everyone listening to let that sink in. 125 times forward earnings. That is nosebleed territory. At that multiple, this stock is essentially priced for perfection. Any stumble, any delay in their manufacturing roadmap, and the market will punish them brutally.
Valuation risk is absolutely the headline concern. When you are priced for perfection, you really do have to execute flawlessly.
And their execution is still a question mark. If you look closely at that Q1 report, despite the impressive top-line revenue growth, the Foundry segment's operating losses actually widened slightly year over year.
Yeah, they did.
They went from a $2.3 billion operating loss to a $2.4 billion loss. They're actively bleeding cash to get these fabs running, and there is immense execution risk here regarding the actual science. You mentioned the Apple talks, but it's important to note that Apple reportedly expressed serious reservations during those meetings.
True.
Apple explicitly cited concerns that Intel can't reliably offer the same production yields and scale as TSMC.
And yields are everything in this business.
Exactly. For the listener, yield is the percentage of chips on a silicon wafer that actually work. If you bake a batch of 100 cookies and 40 of them are burnt, your yield is 60%. Intel's yields have historically lagged behind TSMC. Apple demands near perfection. If Intel can't hit those yields, Apple walks away. That's a huge red flag.
Those are highly valid points. The foundry business is incredibly difficult and they are playing catch-up. But here is the counter-argument, and frankly, why the market is willing to stomach that 125x PE ratio.
Okay, let's hear it.
The structural demand for AI compute is so massive and the global supply is so constrained that Intel can actually sell imperfect silicon at premium prices right now.
Wow, just because people are that desperate.
Exactly. The market is so desperate for capacity that they don't have to be perfect to be profitable. And as we discussed, that massive $2.4 billion operating loss is heavily mitigated by the U.S. government's financial backing. They have a margin of error that other companies simply do not have.
So with everything on the table, what's the final verdict? How should a listener position themselves, given the extreme momentum, the geopolitical tailwinds, the desperate need for capacity, and the undeniable valuation risks?
After synthesizing all the fundamentals, the technical breakouts, and the strategic repositioning, the final rating here is a bullish score of 8 out of 10.
An 8 out of 10, that's a high conviction rating.
It is, but it comes with a very specific time horizon. The long-term view here is that this is a multi-year hold.
Right.
If you are buying here, you have to understand that short-term volatility is absolutely guaranteed. You do not go up 114% in 1 month without experiencing some violent pullbacks and profit-taking along the way.
Naturally.
But if you zoom out, the true value, unlike, the full scaling of that 14A node, the realization of these advanced packaging contracts, and the potential conversion of these Apple exploratory talks, that will play out over a 2 to 3 year execution cycle. You are holding this for the completion of the turnaround, not a quick day trade.
Need emergency cash. MaxLend Loans offers short-term installment loan options up to $3,750 for eligible customers. Apply through the link below and carefully review the APR, fees, repayment terms, and total cost before accepting any offer.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.
Before you go, just think about this for a second. We spend so much time worrying about the software of the future, the algorithms, the AI model generating art and writing code. But none of it exists without the physical, microscopic architecture being forged in these multi-billion-dollar factories. Are we witnessing the rebirth of American industrial dominance right before our eyes, disguised as a simple stock chart? It's definitely something to think about. See you next time in the Deep Dive.